We've witnessed the effects of inflation on the U.S. economy in several ways this year. Continued high inflation is the main reason behind the Fed's decision to raise interest rates. Higher rates have affected the housing market due to higher mortgage rates. They have also made the cost of borrowing higher for many businesses. Inflation has affected consumer spending, with major retailers such as Walmart noting that they have seen consumers scale back spending on items like clothing. They expect to see similar cutbacks on other discretionary items like furniture in the near future. We've also seen significant wage inflation, driving up costs for a number of companies. They, in turn, need to raise prices for their goods and services to keep ahead of higher labor and raw material costs. As more data is unraveled, little is known of how likely Americans are going to survive this wave of collapse. Interest is more on the average to poor people because they are the ones to be hit the hardest. Let us listen to what Ron Paul has to say about the American economy crash. Don't forget to like and subscribe.
We have to recognize what it is, and one principle is that if an individual or a company or a government, a country, spends beyond its means and lives beyond its means, it will be destined to live beneath its means because you have to pay for it. I think that there's a lot of effort. It's the biggest political issue going on right now, but they're starting with the wrong premise because there have not been very many people in government. I met about 4 that I considered an understanding of the free market and why you should have sound money, why you should have commodity money, why you should not have interference with interest rates, you shouldn't have a central bank. And that is where the real problem is. But if you start with, this is a management problem. Oh, it's Powell's fault, or it's somebody, we need better management and all. No, we need a different system. This system doesn't work. It has never worked in history. And we had a token relationship of our dollar to gold all through my lifetime until August 15, 1971, when that was severed. And then we lost the unit of account. There's no definition of a unit of account, and that makes for a chaotic market, and it makes it very difficult. And all the government can do and all the politicians can do, and just look at it, spend more money. And right now, today, they're bragging, and the Democrats are bragging about Biden. You know, he is on a roll. He got 4 big bills passed. He's going to solve the problem of inflation. Well, they all spent money. And it's all inflationary. So it's all a farce. But I think the basic problem, they come from the wrong premise that you can have a world currency, which is so important, don't have market interest rates, and then try to run an economy because you don't have savings. The people don't save. That's not where capital comes from. Capital comes, in a sense, from the Federal Reserve creating more to dilute the capital that exists. And it's just it's so far removed from a market economy, so people don't know about it, and they don't argue the case, they don't teach this, so therefore they're just looking for better managers and better legislators and people who have to sacrifice a little bit, all kinds of nonsense, or change the definition. It causes recessions and depression. But no, we don't have a recession. We just changed the definition of it to make it sound better. But we can't get away with that for very long. People are waking up. They know whether they woke up over all the nonsense associated with COVID and all the lockdown, and the people are waking up now. Right now, there's an enlightenment about how much money should we be sending to Ukraine? What are we doing there? And we've been doing this. We've been doing it since World War II. We fight these wars. They're not declared, and there's no end to them. And because we have a special situation, wealthy country, a lot of natural resources, a remnant of the free market, and people trust the Americans to print money because everybody in the world wants the dollar now because things are rocky. But that's not the solution. What we need is a sound currency and an understanding of how a market works, and why we should never have a group of people in secret decide what interest rates ought to be, because they don't know. You can't. People ask me, what would you do, Ron, if you were there and you had to set interest rates? I go, I'd resign, know, I don't know what the interest rates should be. The market will. Without that, you can't run an economy very well.
The economy shrank by an annualized rate of 1.4% in the first quarter, not because consumers stopped spending, but mainly because we had a big jump in our trade imbalance. Imports surged nearly 18% on an annualized basis, while exports fell. Economists at ISI Evercore estimate the blowout in the trade gap crimped real GDP growth in the quarter by 3.2%. Consumers in the U.S. received generous payouts from the federal government as both Presidents Trump and Biden stepped in to offset the short-lived but severe impact from the COVID-19-induced shutdowns. COVID-related relief programs helped the economy bounce back fast. So fast that by the time Biden entered the Oval Office, GDP was growing at better than 6% and jobs gains were surging. Unhappily, the Biden administration could not leave well enough alone, and with Democrat-only votes, soon passed the $1.9 trillion American Rescue Plan, ARP. That bill poured gasoline on the roaring recovery already underway, pumping up consumer incomes and spending, even as manufacturers and retailers struggled to meet demand. In addition to hyping spending, the ARP allowed millions to stay home, taking advantage of $1,400 relief checks, increased unemployment benefits, rent moratoriums, expanded food stamps, and other benefits. As inflation heated up month to month, Biden, Treasury Secretary Janet Yellen, and Federal Reserve Chair Jerome Powell chirped optimistically that price increases were transitory and nothing to worry about. Consumers, though, knew better. They knew that the cost of everything, gasoline, food, and cars, was going up. They listened to the likes of former Treasury Secretary Larry Summers, who predicted that more federal spending would lead to more inflation. And they did not believe Joe Biden, who continued to promise that his Build Back Better program, which honest analysis suggested could cost as much as $5 trillion, would bring inflation under control. Now, the long-dormant Federal Reserve is finally energized to address rising prices by aggressively raising interest rates. Unhappily, because the Fed dithered, it must apply a sledgehammer to the economy rather than taking a more measured approach. Expectations of a recession are increasing. Even Yellen acknowledges that engineering a soft landing, that is, avoiding a recession, will take luck. Not exactly the reassurance investors were looking for. There are signs that inflation is peaking, but also indications that price growth will remain elevated for some time. First off, we have entered a wage price spiral, driven by the acute labor shortage. Wages and benefits rose 4.5% in the first quarter compared to the year before, the fastest increase since at least 2001. With 11.3 million jobs available and fewer than 6 million people looking for work, upward pressure on pay is likely to continue. At the same time, Biden and his administration, enthralled to his backers in organized labor, are encouraging unionization at companies such as Starbucks and Amazon, which will lead to higher pay, to be passed along to consumers. The Biden White House is also pursuing increased regulations and higher taxes on industry, which, if enacted, will further elevate costs. With luck, progress on these fronts will be minimal, but the risk remains. There are also issues beyond the control of the White House. The war in Ukraine and lockdowns in China have exacerbated supply chain problems that continue to make the availability and delivery of goods more expensive. Those problems are ongoing. So, here we are, with stock prices plummeting. The S&P is off nearly 13% this year, while tech stocks have recorded even sharper losses of 21%. In addition, higher interest rates will likely put a lid on home prices, which will impact the net worth of the two-thirds of the nation who are homeowners. Many liberals believe only wealthy Americans own stocks, but that is not true. Gallup shows 56% of Americans say they invest in stocks, and that likely doesn't reflect millions who own shares indirectly through their pension or retirement plans. While a recession has traditionally been defined as two back-to-back quarters of declining gross domestic product, GDP, there has been some discussion about whether the current economy can be classified the same way due to some of the abnormal factors at play, including a robust labor market. Not long ago, a recession seemed to strike America roughly once a decade. But only 2 years after the first lockdowns, the business cycle is turning at a sickening speed, and another one already seems to be on its way. If you are like most people, your memory of downturns will be dominated by the past two, the financial heart attack in 2007 to 2009 and the pandemic-induced collapse in 2020. Both were severe and highly unusual. By their standards, America's next recession will almost certainly be milder and more pedestrian. But because the world economy, asset markets, and America's politics are all fragile, it may yet have nasty and unpredictable consequences. There is no escaping the squeeze ahead for America's economy. Surging food and petrol prices are eating into people's spending. In April, consumer prices were 8.3% higher than a year earlier. Even excluding food and energy prices, annual inflation is 6.2%. Supply chain problems could flare up for as long as war rages in Ukraine and China sticks to its zero-COVID policy. A U.S. economic collapse would create global panic. Demand for the dollar and U.S. treasuries would plummet. Interest rates would skyrocket. Investors would rush to other currencies, such as the yuan, euro, or even gold. It would create not just inflation, but hyperinflation, as the dollar would lose value to other currencies. If you want to understand what life would look like during an economic collapse, think back to the Great Depression. The stock market crashed on Black Thursday. By the following Tuesday, it was down 25%. Many investors lost their life savings that weekend. By 1932, 1 out of 4 Americans was unemployed. Wages for those who still had jobs fell precipitously. Manufacturing wages dropped 32% from 1929 to 1932. U.S. gross domestic product was cut nearly in half. Thousands of farmers and other unemployed workers moved to California and elsewhere in search of work. 2.5 million people left the Midwestern Dust Bowl states. The Dow Jones Industrial Average didn't rebound to its pre-crash level until 1954. In the debate over recession, no recession/soft landing, hard landing, it all comes down to the behavior of the U.S. consumer. Peter Bukvar, chief investment officer with advisory firm The Bleakley Group, said in a report. Lower-income households will certainly be most impacted by the direction of real wages, while upper ones will most likely be influenced by the direction of the stock market from here. Those in the middle will get impacted by both. We hope to not experience a crash like that of 2008 or anything close to the Great Depression. Americans and the world at large are advised to find ways of preserving their capital and ensuring they have means of survival in the case there is eventually a crash. Stay tuned as we bring you more news about the economic situations around the world. Don't forget to hit the like button, subscribe, and leave a comment below. Thank you for watching.